The amount of gold that's been stood for delivery is about 250 tons. 250 tons. And the interesting thing is that since that time, the warehouse stocks have contracted by almost exactly the same amount. Now, the key to this is to understand these aren't traders buying gold. These are people getting the hell out of fiat. They're not going to get back into fiat. That gold is gone, vanished. Well, the way I always look at gold is it's not gold going up. It's the paper currency, you're measuring it going down. I mean, it's really as simple as that. I mean, in dollars, remember that it was $35 to the ounce. That was the official rate. When it went off the gold standard, the Bretton Woods agreement. And we're close to 1% of that now in terms of the dollar's purchasing power. That's actually what's been happening. In the case of sterling, I mean, we've got an even longer history because before the First World War, you could exchange one paper pound for one sovereign. The sovereign now is 600 paper pounds. What's happened? Has the sovereign gone up? No, it's the paper pound going down. It's a far better measure of the loss of purchasing power of a currency than, say, the consumer price index, which gets fiddled, as you know. So that's the way I look at it. And I see the dollar is going to continue to go down in terms of its purchasing power. It must do. It's certainly not going to recover. I mean, any recover would be extremely short-lived. Well, that is a fascinating story. So far as I was aware, until fairly recently, I was the only person talking about the stand for deliveries on COMEX. They are absolutely massive. And funnily enough, I was looking at these numbers the other day. I mean, up to now, from Liberation Day, April the 2nd, the amount of gold that's been stood for delivery is about 250 tons. 250 tons. And the interesting thing is that since that time, the warehouse stocks have contracted by almost exactly the same amount. Now, I think there's a degree of coincidence in there because there are leads and lags in terms of stands for deliveries and actual withdrawals from the warehouse system. But it's these stands for deliveries which are important. So let's go back a little bit. When we go back to the beginning of this year, you saw big premiums on COMEX. And these premiums came about because there was a concern on COMEX that President Trump would introduce 25% tariffs on everything, because that's what he said he would do, basically. And so they thought, well, gold and silver, okay, we have got these stands for deliveries, we've got these obligations, and we've got to make sure we've got the cover for it. So you can see that this led to a substantial premium on the futures. That created an arbitrage, if you like, between COMEX and other centres, whereby physical gold was moving from other centres, principally London and Switzerland, but even Mumbai was involved in this. You know, effectively the bonded warehouses in Mumbai were funneling some of their gold over to COMEX as well. This is a substantial move. Not only that, but this stuff was coming out of the Bank of England. Now, the Bank of England does store some gold on behalf of commercial entities. By that, I mean, you know, either bullion banks or large funds or whatever. But this gold is basically leased gold, which is under the temporary ownership of bullion banks, you know, and operators, if you like, in the London bullion markets in London. So, you know, this is gold which has got to be returned. So huge numbers have left the Bank of England and also the LBMA and gone over to COMEX. Now, I would guess that what's happened is that the arbitrageurs have covered the price risk in the papers market. I mean, you know, they must do. It's quite simple. You know, the easy way to do it is basically you buy out of the money calls or something like that, and working that sort of derivative, you put a cap or a cap on your potential losses if gold continues to go up. Meanwhile, you look forward to the opportunity of closing your arbitrage, because this isn't just a one-way trip. They don't own the stuff really. I mean, they only temporarily own it, so they've got to get it back. Now, if it's being delivered out of COMEX vaults and stand for deliveries, then where's this going to go? How are they going to get this gold back? That's a big, big question. Now, I've been the only person, to my knowledge, really sort of pushing this line as an explanation for what happened. But then about 2 weeks ago, 3 weeks ago, we had something from the ECB, because the ECB was concerned about the increasing level of derivative exposure in precious metals, and particularly gold, as a result of what happened. And they described exactly what I said. They said that gold was going over there. You had stands for deliveries in COMEX, and the gold has effectively disappeared. But what's happened is that Eurozone institutions have increased their paper derivatives by 58%. In other words, the coverage isn't physical, it's just all paper. Now, so we had the story confirmed by the ECB. I think that's a very, very important point. It's not just me shooting off in the long grass. So how do we get this back? It's gone. We don't know who stands for delivery, but we're pretty sure that these are hoarders, not traders. I mean, I was listening to someone. I think it was probably someone like John Reed or someone from the World Gold Council, and he was assuming that the rise in price would create the profit opportunity, which would bring the stock back into the market. By stock I mean physical bullion. Mm-hmm. No, and the key to this is to understand these aren't traders buying gold. These are people getting the hell out of fiat. They're not going to get back into fiat. That gold is gone, vanished. Well, we don't know the answer. I would suppose that they are smaller central banks. I think they're sovereign wealth funds. And I think they're the super rich in Asia, of which there are now many, 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 many ultra high net worth in families. So I think that's where it goes. I mean, a long time ago, I was reading about one Egyptian guy who was trying to get his way out of, the Egyptian pounds, which was sinking like a stone. And he was putting something like $1 billion into physical gold, or 2 billion or something. I mean, you don't need an awful lot of that sort of demand to clean out the market. There is no real physical. I mean, okay, you and I can go in and buy a few coins or small bars or whatever, but you really want to take, you want to take delivery of a couple of tons. Ooh, join the queue. This is not something that's going to happen easily. So the point is, let's just go back to the problem. The problem is that a central bank, which had its gold stored at the Bank of England, has so far been quite happy to lease it out to help pay the costs of storing it at the Bank of England. Mm-hmm. And the Bank of England has been very happy to act as agent for it and saying, well, don't worry. It sort of, it'll remain in our vault. So we've still got control over it. Yeah, like hell, it's gone. So what does the central bank think? And I'm talking about, like the Central Bank of Finland, for example, who did disclose that they had something, I think it was something like 60 tons in the Bank of England. This was quite some time ago. And they made a big error by telling me that they were leasing half of it. And then they went quiet on the whole thing. I had a Finnish friend who gave me the translation, so on. So, okay, you're the Bank of Finland. You're sitting there, you're thinking, God, our gold's gone. What are we going to do? It's a quick call the Bank of England. Where's it gone? Well, Well, the answer basically is that you're not going to do any leasing ever again. And probably you're going to turn around and say to the Bank of England, hey, come on, we want to ship back to us, just like the Bundesbank did to the Bank of New York, what, about 10 years ago? You know, the Federal Bank of New York, 10 years ago. Now, this is desperately important because the liquidity in the paper market depends on this leasing game and the rehypothecation of leased gold. And it's a circus which is run by the Bank of International Settlements and also the Bank of England and also the New York Fed. They have lost their liquidity and there's a hell of a lot of gold gone missing. So how do we sort this one out? I mean, the answer basically is that the paper market is ending along with the fiat currency system. And this ending of the paper market is not going to be a simple wind down at all. No, I think it's quite likely to create crises of delivery, which I wouldn't want to be. I wouldn't want to have counterparty risk in the paper markets at all. And if the bullion paper market has problems, then you can imagine that that's central to virtually the whole of the derivative industry, not directly, but indirectly, because, of course, the people who are playing the paper game in gold are the same people playing paper games in other derivatives, the same players, the same hedge funds, the same banks. So on that basis, you know, systemic risk in the gold market is actually a very, very serious issue. I think it's bound to, because all these markets are basically priced on the back of derivatives. You know, if you can't hedge, let's say your copper or whatever because of counterparty risk or whatever, then obviously it's going to have an impact on underlying prices. It must do. I would think it would lead to relatively immediate demand for virtually all commodities, because the point about derivatives is that you can have a derivative without actually having to own the stock. So, you know, you can always use derivatives to protect your price ahead of delivery or ahead of a commitment. But when you can't use the derivative anymore, then you know, you've obviously got to go out and get the stuff in before you, because you're going to have obligations, if you like, on the other side in terms of delivering product. You know, whether it's mild steel or copper or silver or lithium or whatever it might be. Yeah, and also oil too, energy. That actually could be a very, very big consideration. Yeah, that was a rather different situation. The problem there was the incompatibility of the delivery on a contract. You had some Chinese business, which was a very, very big dealer in nickel, but they couldn't deliver nickel in the form in which the contract was set. So in other words, they defaulted on the contract. Is the problem that any market has, acting as an intermediary between you know, different parties, is that the market itself takes on the counterparty risk. You know, you deal with the LME and you sort of, you know, you're guaranteed by the exchange, as it were. But that only happens to the extent that the LME can actually deliver on its obligations. So it has this protection in its own rules that, you know, it can, under certain circumstances, cause contracts to be cancelled, which is what it did. And, you know, obviously quite a few people were upset about it. I don't actually follow it too closely. In fact, I hardly follow it at all. But what I would say is that the price has been in the doldrums for an awfully long time. I mean, as you can see, going back. You know, it's a very, very important metal. I mean, it's important from the point of view of exhausts, automotive catalysts and things like that. It's, yeah, I would guess that rather like the silver market, we've had a long period of lack of supply given the level of demand. And I'm not quite sure how this is sort of, you know, sustainable in a sense. But of course, when things begin to break, things like that really do run. And I would think that there's a good possibility that a few people in the market have got themselves caught rather badly short. I mean, for example, I could imagine motor manufacturers may be sort of thinking, well, we can always get hold of platinum because the price never goes anywhere, and find suddenly that they're uncovered. So they've got to go in and buy and drive the price even higher. So I would, I can't see there's anything more than that. I mean, palladium is the other one, of course, and they've been using palladium a lot more in catalysts for motors, and that has been a lot more volatile. And the other platinum group metal, rhodium, I don't know where that is now, but I mean that was just completely unobtainable at one stage, and it was up at something like $14,000 an ounce or something. I mean, I don't know where it is. I haven't seen rhodium for an awful long time. But you used to be able to trade in rhodium, but basically there was none available, so there was no trade. I mean, obviously, you're going to find prices go higher, and it's interesting if you look at sort of the various commodity funds and so on and so forth. I mean, they've all been sort of breaking out on the upside, or tending to anyway. And I think that certainly does feed through. What it does is it puts a floor on prices, certainly of consumer prices. It squeezes industry very, very badly, and quite a lot of industry might even have to close down on it. And yes, it sort of front runs what's really happening to the currencies, because what do governments do under these circumstances? Well, if you get a sort of commodity prices driving prices up, you can't possibly have voters doing without. So you print the money one way or the other for them to be able to buy things at a higher price. You're getting cause and effect a little bit sort of muddled here, but I think that's basically what happens. But I mean, it's the fall in the purchasing power, which is really behind it all. And of course, when you get a fall in the purchasing power of a fiat currency, it doesn't necessarily do it on an even, sort of downward curve. There are going to be moments when you get panics, which work against the currency, and you're going to get periods perhaps of the panic has passed and there's a little bit of stability. Like this summer, nobody's considering anything, and okay, the dollar's going down, but the other side of that is the euro's going up, the yen's going up, sterling has even gone up, and you sort of begin to think, well, at some stage, these currencies, their purchasing power is really going to go down, because the best currency in the G7, of course, the leading currency in the G7 and around the world is the dollar, and if the dollar tanks, if the dollar's got problems, oh my God, we've got problems. You get a cold, we get pneumonia. Some stage that's going to happen.